Welcome to our lecture about collateral management. My name is Tim Glauner. Before we begin, please note the information regarding copyright and trademark. We'll begin with a brief introduction, then set the stage for collateral management by looking at the 2008 financial crisis. 2008 was a turning point that redefined how margin and collateral are managed globally. Next, we'll explore collateral practices across key asset classes: bilateral OTC derivatives, centrally cleared derivatives, exchange-traded products, repos and securities lending, and TBA contracts. We'll then shift into the operational layer, including margin workflows and settlements. From there, we'll dive into collateral optimization. This optimization allows firms to select and pledge assets to minimize cost. Let's get started with the introduction. In financial transactions, counterparty risk is a significant concern. This risk arises as one party may fail to fulfill its obligations. To mitigate potential losses from such risks, collateral is used. Collateral refers to assets that are pledged as security for the transactions. These assets can be in the form of cash or securities. Common types of collateral includes cash, bonds, or equities. By using collateral, parties aim to ensure that obligations are met and reduce the impact of any defaults on the transaction's outcome. Collateral is required primarily to reduce counterparty credit risk. By requiring collateral, parties limit their exposure and minimize potential losses in the event of a default. This practice also enhances market stability by providing a safety net, which in turn boosts investor confidence. Collateral management involves two key components: initial margin, IM, and variation margin, VM. IM is the collateral posted up front when a trade is initiated to cover potential future exposure and acts as a buffer against default scenarios. On the other hand, VM represents daily settlements that reflect changes in mark-to-market profit and loss, ensuring minimal ongoing credit exposure between counterparties. Let's list the financial products that require collateral management and briefly mention how the collateral is managed. We'll then go later into each one in detail. Bilateral OTC derivatives utilize both IM and VM under agreements like the ISDA Credit Support Annex CSA. Centrally cleared derivatives have standardized IM and VM managed by the central clearing parties or exchanges. Exchange-traded derivatives involve margin requirements set by exchanges with daily settlement processes. Repos and securities lending use haircuts on the specific collateral as an IM equivalent. Periodic checks are then done to ensure that there is enough collateral. That's similar to the VM process in the previous asset classes. To be announced securities, TBAs, require upfront IM for future exposure with daily VM adjustments based on market valuations. There are many parties involved into the end-to-end collateral process. The key entities involved in managing collateral includes the bank's internal legal entities. They manage their own CSAs, margin thresholds, and custodial setups crucial for regulatory compliance. Counterparties in the transactions are essential for calculating the exposures, making margin calls, and resolving disputes under ISDA CSA agreements. Future commission merchants, FCMs, post margins to CCPs so that clients can manage both IM and VM directly from the client accounts. And further entities are involved, the central counterparties. They set the margin schedules and they're bearing the ultimate risk for the cleared trades. They're also called the exchanges. Cash custodians manage cash collateral, ensuring settlements are processed through systems like SWIFT or Fedwire. Security custodians handle pledged securities, ensuring proper settlement processes, including eligibility checks and substitutions for equities and bonds. Lastly, the Federal Reserve plays a pivotal role. The Fedwire facilitating USD payments, essential for same-day liquidity statements. All these entities will appear in the following slides in some form. So to summarize our introduction, collateral is a fundamental tool for mitigating counterparty risk in capital markets. It plays a crucial role in maintaining trust, liquidity, and overall stability across the financial system. Following the 2008 financial crisis, collateral management became a core focus of major regulatory reforms, including Dodd-Frank in the US and EMIR in Europe. Today, collateral is no longer viewed solely as a risk mitigant. It's also a strategic funding tool, directly impacting a firm's liquidity, trading capacity, and profitability. Effective collateral management is critical for maintaining liquidity resilience, especially during periods of market stress, when the ability to move and optimize collateral quickly can determine whether a firm withstands shocks or faces funding strain. We're now diving into the 2008 financial crisis and discuss how the lack of collateral played a significant role and how we have learned from it. The 2008 financial crisis was a pivotal moment that exposed significant flaws in the practices surrounding bilateral derivatives margining, also known collateral. Prior to this crisis, collateral practices varied widely among counterparties, leading to uncollateralized exposures that contributed to systemic losses, as seen in the defaults of Lehman Brothers and AIG. The terms of credit support annexes, CSAs, often lacked clarity, enforceability, and legal certainty. Furthermore, ratings-based thresholds designed to trigger actions upon credit downgrades failed during sudden market events or cliff events. These issues not only created liquidity gaps, but also led to pro-cyclical margin calls and delays in resolving disputes. The situation underscored the urgent need for reforms, including daily margining processes, segregation of collateral to protect trading parties from counterparty risk, and robust mechanisms for dispute resolution. Following the 2008 crisis, several key regulator frameworks were introduced globally to address these vulnerabilities. The first one is UMR, Uncleared Margin Rules. These rules mandate both initial margin and variation margin for uncleared trades. The application of these margins is based on thresholds tied directly to the size of a swap book. We will discuss UMR in more detail later on. Dodd-Frank Act Title VII. This US regulation mandates central clearing of derivatives and requires collateral segregation while ensuring adherence to the UMR standards. European Market Infrastructure Regulation, EMIR. Similar in intent to Dodd-Frank, but applicable in the EU. EMIR enforces derivative clearing through central counterparties, same as in the US, along with detailed reporting requirements and stringent risk management protocols for over-the-counter derivatives. Lastly, we have Basel III. The set of international regulatory standards enhances bank capital adequacy requirements globally. It improves liquidity frameworks and strengthens overall bank risk management practices. These measures collectively aim at enhancing transparency, reducing systemic risks associated with its derivatives transactions, and ensuring more resilient banking systems worldwide. We'll now go through each asset class and discuss the collateral requirements and its management. We will start with bilateral over-the-counter derivatives. Bilateral over-the-counter OTC swaps are contracts negotiated directly between two sophisticated, independent legal entities. Each party in the trade assumes its own risks and responsibilities. These trade agreements are governed by International Swaps and Derivatives Association, or ISDA. The two counterparties involved operate under credit support annexes, or CSAs. CSAs define collateral rules, include the eligible collateral types, haircuts on collateral values, minimum transfer amounts, interest on posted collateral, netting sets, among other terms. Importantly, these contracts require both initial margin and variation margin to manage the credit exposure. Let's consider an example of key terms in a CSA. The counterparty might be Citibank North America in New York, with applicable trade types including swaps, swaptions, caps and floors, and money market instruments. Eligible collateral could include US dollar cash, US treasuries, mortgage-backed securities, or corporate bonds. Netting rules may allow for swaps to be netted with swaptions, but not with TBAs or repos. Haircuts might be set at 2% for US treasuries and 5% for mortgage-backed securities, with a minimum transfer amount of $250,000. Initial margin is required under UMR to protect against potential future exposure. Let's talk what potential future exposure actually really means and what IM protects you from. The risk IM covers is that sometime in the future you have a positive mark-to-market on the trade, and the counterparty stops paying variation margin or misses some other payment. On that day, you first have to figure out if this is really a credit issue and the counterparty will never pay, or it's just a temporary thing. When you've decided that the counterparty will fail, then you will find a new counterparty for the trade. You can imagine that this whole process of figuring out if it's a real credit event and then finding a new counterparty will take time. This time period is called the margin period of risk, MPOR, as the trade value and exposure might still increase, but the counterparty has stopped paying variation margin. So losing this change in mark-to-market is what IM protects you from. There are two ways to calculate IM for bilateral swaps. First, the ISDA SIM model. This is risk sensitive and looks at the entire portfolio, taking into account factors like delta, vega, and curvature. Second, the grid method. It applies fixed percentages to notional amounts and doesn't consider risk sensitivities. It's much simpler and mainly used by smaller firms. Larger institutions typically prefer SIM for its accuracy and potential margin offsets. Whichever method is used, IM must be posted to a segregated third-party custodian. With SIM and grid, the amount is calculated when the trade is booked. If exposure shifts beyond the minimum transfer amount, an IM call is triggered. In practice, this is recalculated daily to capture new or amended trades. The average aggregate notional amount, abbreviated as ANA, is defined as the average notional amount of over-the-counter derivatives positions calculated over a specified period. This metric serves a critical purpose. It determines whether a financial institution meets specific regulatory thresholds set by frameworks such as EMIR in Europe or Dodd-Frank in the US. The calculation involves averaging the daily notional amounts of all OTC derivative contracts over a rolling 12-month period. From a regulatory perspective, ANA is pivotal because it defines margining requirements for non-centrally cleared derivatives and is crucial for capital and reporting compliance. In terms of impact, breaching these thresholds triggers mandatory clearing alongside margining and reporting obligations, which helps regulators assess systemic risk within derivatives markets. The implementation of UMR occurred in phases based on ANA. Phase 1 and 2 included major players and global dealers like JP Morgan. Phase 3 and 4 included large international banks such as HSBC. By phase 5 and 6, even smaller asset managers like Neuberger Berman were included. Each phase has specific thresholds that dictate when institutions must comply with these margin requirements. In the earlier phases, up to phase 4, use of SIM model was mandatory and the grid method was not allowed. In later phases, such as phases 5 and 6, the grid method became permissible if both parties clearly agreed to it bilaterally. Custodians hold initial margins separately for each party, without netting the two amounts, to ensure full protection in the event of bankruptcy. SIM remains the industry standard, and we will now discuss it in more detail. So the ISDA SIM method focuses on portfolio sensitivities to various risk factors and organizes these into distinct risk buckets. The sensitivity measures within SIM include delta, vega, and curvature. Delta sensitivity refers to the change in portfolio value resulting from a 1 basis point move at specific tenors such as 2 years, 5 years, or 10 years. This measure captures linear risk across fixed maturity points. Vega sensitivity involves changes in portfolio value due to shifts in implied volatility. It specifically addresses exposure to volatility risks present in options. Curvature sensitivity accounts for changes in value arising from large market shocks that go beyond what delta captures. This measure is crucial for understanding nonlinear and tail risks within the portfolio. We categorize then the risk classes into 5 main types: rates, foreign exchange, credit, equity, and commodity. For interest rate curves, sensitivities are calculated at specific fixed tenors. These tenors typically include 1 year, 2 year, 5 year, 10 years. Within a single currency and risk class, we aggregate sensitivities using correlations that are specific to each tenor. When dealing with risks across different currencies or across asset classes, we use lower cross correlations for aggregation. The approach shares algorithmic similarities with a fundamental review of the trading book's standardized approach. For more detailed insights on this topic, refer to my FRTB course and the specific lecture titled FRTB SA Sample Calculation for USD SOFR Interest Rate Swap. In this lecture, we fully reconcile in Excel an FRTB capital charge for a similar method. The first step in the SIM algorithm is to identify all relevant risk factors across different asset classes. These asset classes include interest rate, FX, credit, equity, and commodities. Next, calculate delta, vega, and curvature sensitivities for each risk factor and tenor. Each sensitivity must then be assigned to the appropriate risk bucket. A risk bucket groups sensitivities by currency and maturity band to aggregate similar risks effectively. Next, calculate delta, vega, and curvature sensitivities for each risk factor and tenor. Each sensitivity is assigned to the appropriate risk bucket. A risk bucket groups sensitivities by currency and maturity band to aggregate similar risks effectively. For example, mapping sensitivities to risk buckets involves categorizing them based on currency and maturity bands, such as USD 2 to 5 year or Euro 2 to 5 year buckets. You can see that the 2-year SOFR sensitivity and the 2-year Fed funds FF sensitivity all go into the USD 2 to 5Y bucket. Then apply prescribed risk weights to each sensitivity within its respective risk bucket. The SIM algorithm continues with the aggregation of weighted sensitivities within each bucket. This process uses prescribed intra-bucket correlations to combine these sensitivities effectively. Next, we aggregate across different buckets by applying cross-bucket correlations when necessary. SIM requires to use 3 different scenarios and then pick the scenario with the maximum value. So we then apply correlation scenarios which include low, medium, or base, and high correlations. The final SIM amount is determined by taking the maximum aggregated capital from the 3 correlation scenarios. There are so many algorithmic parallels between this approach and the FRTB standardized approach. The grid method is a straightforward standardized approach for calculating IM. In this method, the portfolio's IM is simply the sum of each trade's IM. A predefined 2-dimensional grid determines the trade initial margin as a percentage of its notional value. This grid considers, among other information, asset type and maturity. The method does not account for netting, correlations, or diversification across positions. As a result, it tends to be conservative and requires higher collateral. Because of its simplicity, it remains unaffected by specific portfolio characteristics or market fluctuations. Let's look at an example that illustrates its simplicity. Here, for swaps and tenors up to 2 years, the margin is 1% of the notional amount. For tenors between 2 and 5 years, it's 2%, and so on. For swaptions, we have a different setup. At-the-money swaptions require a margin of 4% of the notional value. Out-of-the-money swaptions need a lower margin at just 2%, and in-the-money swaptions have a higher requirement with a margin of 5%. Let's illustrate this with an example. Suppose you have a $100 million interest rate swap with a maturity of 4 years. According to our grid values, this would require a margin of 2%, resulting in an initial margin requirement of $2 million. Very simple. Initial margin must be held with an independent third-party custodian according to UMR rules. This ensures the safety and integrity of the collateral. The custodian account must be segregated and non-rehypothecable, meaning the collateral cannot be reused by the custodian. It should also be bankruptcy remote to protect against insolvency. A dual account structure is required, involving both a pledger and a pledgee account, often referred to as we for the pledger and they for the pledgee. The daily workflow begins with running SIM to calculate the initial margin requirement. Once calculated, instructions are sent for movement using MT542 Swift messages for delivery or through a tri-party API system. The custodian then confirms receipt of this collateral and assesses its value. Failure to post this margin can lead to disputes between parties involved in the swap transaction. It may also trigger reporting obligations and result in penalties being imposed on those who fail to comply with these requirements. In this slide, we focus on variation margin. We will illustrate how VM is calculated from one day to the next. The example given is a 5-year payer swap with a notional amount of $100 million. Initially, at time T0, the net present value is minus $800,000. So the counterparty is at risk for the value of that exposure. Of course, some of this exposure is already reduced by previous exchanges of variation margins and also initial margin, but we only focus now on VM from one day to the next. By time T1, the next day, this net present value has decreased further to negative $1.1 million. This results in an exposure change of $300,000 for the counterparty. The CSA terms specify that the minimum transfer amount is $250,000. Since the exposure change exceeds this threshold, it triggers the call for collateral posting of $300,000. Eligible collateral includes US dollar cash or US Treasury securities, with a 2% haircut applied to their value when used as collateral in this context. To begin the workflow for bilateral OTC swaps, we start with an end-to-end market data snapshot. This snapshot is used to compute the net present value and exposure of the swap positions. By 9 a.m. On the following day, a margin call is issued through platforms like Arcadia. Next, we move to collateral section. Collateral must be extracted from eligible inventory while optimizing funding costs. It's crucial to avoid breaches in concentration and eligibility during this process. Systems usually check on this workflow, but it's still often done in Excel and manually. Instructions to execute these pledges occurs via Swift messages MT542 or MT543 or through a custodian's API. Finally, reconciliation and confirmation need to be completed by 1 p.m. Eastern Standard Time to prevent any disputes from arising. This concludes our discussion of collateral for bilateral non-cleared swaps. We now move on to cleared swaps or cleared derivatives in general. Centrally cleared derivatives are standardized contracts that are transferred to a central counterparty, CCP. An example of such a derivative is a 5-year vanilla fixed versus SOFR interest rate swap executed between two US financial institutions. In this setup, the CCP takes on the credit risk, which helps ensure the integrity of the trade. The process involves novation and clearing through a futures commission merchant, FCM, to various CCPs like LCH, CME, Eurex, or ICE. Margining is an essential part of this system. The CCP's rulebook defines the margining process and includes both daily and intraday variation margin as well as initial margin. Accepted types of margin typically includes cash in dollars or euros, US Treasury securities, and other eligible securities. The management of VM and IM flows is handled by the FCM and CCP. The CCP, also often called the exchange, acts as final arbiter, which minimizes disputes. Broker statements are often accepted or reconciled with internal models to ensure accuracy. Initial margin serves as a risk buffer determined by the CCP using methods like value at risk or expected shortfall. Replicating exact initial margin calculations can be challenging, but APIs from the CCPs are available for pre-trade analysis. The actual IM methods are not fully disclosed to prevent arbitrage opportunities. Variation margin is settled daily in cash, reflecting full mark-to-market changes. Another detail is that cleared swaps do not have actual periodic cash flows. Instead, they use price alignment interest as a substitute mechanism. In the next slide, we will cover PAI. So PAI, or price alignment interest, refers to the interest on daily variation margin posted to a central counterparty. It is designed to remove any unintended economic gain or loss that might arise from cash variation margin. This interest is calculated based on an overnight rate, such as SOFR or ESTR, and it is applied daily. PAI reflects the time value of collateral rather than the accruals of the swap legs. In cleared swaps, there are no periodic coupon payments. Instead, cash flows are replaced by two components, the daily variation margin and PAI. The daily variation margin settles the mark-to-market value and includes the accrued interest. Meanwhile, PAI offsets the cost or benefit associated with using cash as a form of variation margin. Finally, fixed and floating accruals in mark-to-market calculations are settled through this daily variation margin process. The daily workflow for cleared margin begins with the CCP releasing the margin statement. This is typically done through the platform like the LCH portal by 6:30 a.m. Eastern Standard Time. Following this, the FCM debits the variation margin from a cash account. Next is the initial margin process. Eligible collateral for this includes US Treasuries, agency securities, and major currencies. These can be delivered either via an FCM or through a tri-party agent such as Bank of New York Mellon or Euroclear. It's important to reconcile daily against the FCM statement to ensure accuracy and compliance. Additionally, systems are in place to monitor exposure across different dimensions by CCP, by account, and by asset type to manage risk effectively through this whole process. This covered the cleared derivatives. If you have any questions, I wanted to remind you to please post in the Q&A section. So we are now moving on to futures and listed options, which are exchange-traded derivatives. So exchange-traded derivatives, or ETDs, are standardized futures and listed options that trade on organized exchanges like the CME and ICE. These instruments have been around for decades, predating bilateral and cleared over-the-counter derivatives. So common examples include Eurodollar futures, S&P Dow Nasdaq futures, S&P 500 options, or Treasury futures. Swap futures also exist, such as Eris futures, but are less common. When trades occur on these exchanges, they are automatically cleared through the exchange's central counterparty clearing house. This central counterparty plays a crucial role in reducing default risk by acting as an intermediary between buyers and sellers. In regards to collateral, exchange-traded derivatives have responsibilities similar to cleared derivatives. Initial margin is required upfront to open or maintain a position. It is calculated using methods like span or value at risk, which are specific to each exchange. The amount of initial margin needed is sensitive to both market volatility and the size of the position held. Variation margin is settled daily in cash and can only be in USD or Euro. This margin reflects the full mark-to-market profit and loss from the prior stake close. The funds are automatically debited from client clearing accounts through the FCM. The CCP informs the FCM early in the morning about these requirements, who then update their clients accordingly. During periods of high market volatility, intraday margin calls may occur to ensure adequate coverage against potential losses. The SPAN, or Standard Portfolio Analysis of Risk, is a widely used methodology for calculating the initial margin on futures and listed options. It's commonly applied by exchanges like the CME. This method evaluates the worst-case loss across 16 different scenarios. These scenarios include price movements, shifts in volatilities, and breakdowns in correlations. SPAN considers various risk factors such as delta, gamma, vega, and also incorporates cross-margining. Note the terminology change here. In FRTB SA and SIM, the gamma was called curvature. Both refer to second-order sensitivities due to convexity of the mark-to-market function in respect of the risk factors. Importantly, risk is assessed at the portfolio level rather than for individual products. The initial margin is recalibrated daily to reflect changes in market volatility. As market volatility increases, so does the initial margin requirement. Additionally, SPAN allows for offset within related products like equity index futures and options to optimize margin requirements efficiently, but does not allow offsetting among uncorrelated risks such as Euro-dollar interest rate futures and equity futures. Our SPAN risk array provides a visual example of how different market scenarios can impact estimated financial losses. The table outlines various scenarios based on changes in price and volatility. Note the estimated loss numbers are just given as examples, but in the real world, the exchange's pricing models would calculate the numbers. For instance, in a bull market with a 5% price increase and unchanged volatility, the estimated loss is $12,000. If volatility increases by 10% under the same price change, creating a volatile bull scenario, the loss rises to $18,000. In contrast, if there's no price change but volatility spikes by 20%, labeled as a vol shock scenario, the estimated loss is $15,000. A bear market with a 5% decrease in price and unchanged volatility results in an estimated $10,000 loss. When both price decreases by 5% and volatility decreases by 10%, termed as calm bear scenario, the loss reduces to $8,000. A more severe situation occurs when there's a 10% drop in price combined with a 15% increase in volatility. This crash plus vol scenario leads to an estimated $25,000 loss. The worst case scenario across all these model situations shows this maximum projected loss of $25,000. The SPAN initial margin represents this maximum loss across all scenarios considered here. Now that we have discussed exchange-traded products, we will cover repos and securities lending. Repos are short-term funding trades where cash is exchanged for securities with an agreement to repurchase them later. Economically, you can look at it as either a collateralized way to borrow cash at a low rate, or as a way to borrow a security, or if you have the security, to lend it out. These transactions can be structured either bilaterally, which means directly between two parties, or through a tri-party arrangement involving an agent like Bank of New York Mellon or JP Morgan. In these deals, the lender holds the securities as collateral while the borrower receives the cash. Daily margining occurs based on the mark-to-market value of the collateral, typically settled on the same day. Common types of collateral include U.S. Treasuries, agency bonds, investment-grade corporate bonds, and equities. A haircut is usually applied to these assets to account for risk. This haircut is very similar to the initial margin for the other asset classes we had discussed. Margin calls and substitutions are managed through a custodian or a tri-party platform to ensure proper handling of collateral adjustments. Repos also have the ability to transform ineligible assets into clearing counterparty eligible collateral for initial margin requirements. We'll give a use case of this a little later. Explicit pledging of initial margin is not typically required in repos. However, it's often included as a haircut. For example, there might be a 2% haircut on US Treasuries and between 5 to 10% on corporate securities. This haircut acts as a buffer, similar to initial margin, to protect the cash lender from potential counterparty credit losses. Variation margin is determined based on the daily mark-to-market valuation of collateral compared to the cash involved in the transaction. This process helps safeguard against declines in collateral prices. The specific margin threshold and timing for margin calls are established within the repo agreement or tri-party schedule. Let's look at a nice use case of collateral transformation via repo. It's a trade that converts ineligible assets, such as equities and corporate bonds, into collateral that is eligible for central counterparty clearing, like US Treasuries. The process involves several steps. First, you post the ineligible assets as collateral in a repurchase agreement to borrow cash. Remember, repos have maturity dates, so this borrowing will need to be rolled to avoid having to pay back the cash. Then you receive cash from a dealer or tri-party agent. This cash is used to purchase eligible US Treasuries. Finally, these treasuries are posted as initial margin to the central counterparty. This method enhances funding efficiency by preventing the forced liquidation of portfolio assets when they're not immediately eligible for posting as collateral. Now, key factors to consider include aligning maturities between all these transactions, understanding haircuts applied to asset values, and assessing eligible risks of different asset types and managing the timing of repo recalls effectively. So, repos can be bilateral or can be managed via a tri-party agent. In the tri-party repo margining process, a tri-party agent, such as JP Morgan or Bank of New York Mellon, conducts a daily end-of-day market valuation. The margin requirements are then commuted by 6 a.m. The margin movements occur automatically from an eligible collateral pool, including which securities are pledged. Substitution of collateral is allowed based on its liquidity and availability for tri-party repos. The tri-party agent has several key responsibilities. They enforce eligibility criteria and apply haircuts to the collateral. They also optimize how collateral is allocated within the pool and track any corporate actions affecting pledged securities. Corporate actions are basically the coupon payments of the securities. Both parties involved in the transaction have access to detailed reporting through a secure portal or API. Lastly, let's look at collateral for TBAs, which are forwards on mortgage-backed securities. TBAs, or to be announced securities, are forward settling trades commonly used in agency mortgage-backed security markets. These trades allow banks, asset managers, insurers, or real estate investment trusts to gain exposure to mortgage-backed securities before the specific pools are identified. The operations of TBAs are governed by SIFMA and FINRA regulations. Under FINRA Rule 4210, margining is required due to the inherent counterparty risks associated with their forward structure. It's the same concept as before. The forward settling nature is inherently credit risky, as the counterparty may not fulfill the obligation of the forward settling cash flow. So you need collateral to ensure you're protected. Unlike some other financial instruments that might be cleared through a central counterparty, TBA trades are settled bilaterally through broker-dealer counterparties. However, these trades are reported to a central trade reporting platform called TRACE for market transparency. After execution, trades must be reported to TRACE to support market transparency. TRACE is FINRA's mandatory reporting platform for post-trade activity in bonds and agency MBS. Initial margin is required as a key component in trading TBAs. Under FINRA Rule 4210, there may be a requirement for a base margin, such as 2%, in addition to a variation margin. It's called base margin, but it's very similar to an initial margin. The factors influencing this base margin include the type of counterparty involved or if the exposure is above a certain threshold. Variation margin is determined based on daily mark-to-market valuations compared to the agreed forward price of the securities. Minimum transfer amounts are typically set at $250,000. So if the exposure minus the posted collateral is below this amount, no action needs to be taken. Variation margin is settled in US dollars with the dealer and is governed by specific agreement timings and threshold. Since there is no central clearing for the TBA transaction, margin terms can vary depending on each counterparty relationship. This necessitates careful operational tracking for each trade to ensure compliance with these varying terms. Let's go one step deeper here into the margining process. The margining process for TBAs begins with the logging of trade details to trace at execution. These details include the CUSIP, the settlement date, and trade size. The mark-to-market valuation is based on trace or dealer prices. Trace provides executed prices which differ from OTC derivative mark-to-market that rely on models varying by counterparty. Under FINRA 4210 margin rules, a typical minimum transfer amount is $250,000. The margin consists of a 2% base plus daily variation. For exempt counterparties such as mortgage banks and regulated institutions, the base margin is 2%. Non-exempt counterparties like hedge funds face a higher base margin of 4%. Daily exposure calculations determine cash movements to brokers. All records must be auditable and reported to FINRA for compliance purposes. We have now covered a large part of collateral management by detailing the measures and processes for the different types of asset classes. Let's talk about operations across all the trades. Real-time tracking of collateral inventory is quite useful depending on the size and complexity of the institution. It involves monitoring eligible, pledged, and unencumbered or encumbered assets continuously. Data for this process comes from internal systems, custodians, FCMs, and tri-party agents. Some of the key attributes to consider include eligibility according to CSAs or CCPs, the haircut applied to the asset's value, its maturity date, and the currency in which it is denominated. Effective management of these elements is crucial for handling margin calls efficiently and facilitating asset substitution when necessary. It supports optimizations when pledging assets and supports regulatory compliance. Having a single view across all the different asset classes we have discussed is optimal, but requires a central collateral system, which is often challenging to accomplish in larger institutions. Instructions are sent either through Swift messages, MT540 or 543, or through custodian APIs for automated flows. Collateral can settle either delivery versus payment, known as DVP, where cash and securities move simultaneously, or free of payment, known as FOP, where securities move without the cash. Cutoff times vary depending on the custodian, the asset type, and the relevant local time zones, so it's critical to plan margin movements carefully. Before settlement, most counterparties require affirmation to confirm the movement details and prevent operational breaks. For variation margins, settlement typically happens same day, while initial margin or collateral substitutions may settle on a next day cycle depending on the agreement. Once instructions are sent, collateral teams must actively monitor settlement status, track any fails, and handle asset recalls if necessary. Daily reconciliations of portfolios and margin calls is mandatory under UMR and EMIR. Common breaks include valuation differences, collateral eligibility issues, and booking mismatches. We rely on risk systems, custodian reports, and counterparty statements to match exposures. Tools like TriResolve and Acadia support automated matching, but manual intervention is often needed for exceptions. All disputes must be tracked with timestamps, categorized, and resolved within agreed SLA timeframes. Material or age disputes escalate to operations, legal, or front office, depending on severity. We're moving on to collateral optimization. The goal of collateral optimization is to minimize funding cost while maximizing collateral eligibility and operational flexibility. The core strategy is to apply cheapest to deliver logic, weighing haircuts and opportunity costs across available assets. Key inputs into the process includes eligibility schedules from the CSAs or CPPs, haircut matrices, actual funding cost, and any reuse or concentration limits in place. Constraints must also be considered. These include available collateral inventory, regulatory eligibility rules, internal risk policies, and any specific counterparty restrictions. The output of the optimization process is an optimal allocation of collateral across all counterparties and margin calls, prioritizing low-cost, high-eligibility assets and staying within defined operational and regulatory limits. When managing collateral, it's important to consider not just eligibility and haircuts, but most importantly, funding costs. Funding cost represents the opportunity cost of using an asset, whether you could repo it to raise cash or whether you're forced to borrow cash instead. In practice, the funding cost is the repo rate applied to securities and the unsecured borrowing rate for cash. Some assets, like posted cash collateral, may still earn some interest, such as SOFR overnight, but often not enough to fully offset the borrowing cost. The cheapest to deliver collateral is the asset that minimizes overall funding expense while still satisfying margin call requirements. Ultimately, the objective is to balance haircut impacts, repo rates, and liquidity considerations when deciding what to post. In this simplified example, we receive a $10 million margin call. Our unsecured internal borrowing rate is 6%, and SOFR overnight is 1.5%. That means posting cash would still leave us with a significant net funding cost of 4.5%. Looking at available inventory, we have US Treasuries, investment-grade corporate bonds, and equities, each with different repo rates, haircuts, and available amounts. First, we post the full $6 million available in US Treasuries. They have no haircut, offer full effective coverage, and the lowest repo cost at 3.75%. We still need to cover $4 million. We move next to corporate bonds. Accounting for the 2% haircut, we need to post slightly more, about $4.08 million, from our $8 million available inventory. Equities are avoided because their repo rate is high at 7%, and their 15% haircut would require us to overpost significantly. Finally, we avoid posting cash because although SOFR pays 1.5%, the 6% unsecured borrowing cost makes it inefficient compared to using securities. You can imagine that with multiple margin calls from different counterparties and different currencies, this becomes quickly a complex optimization challenge with constraints. This concludes the lecture. Let's quickly recap what we covered today. We started with an introduction to collateral management and the regulatory context that emerged after the 2008 financial crisis. Then we reviewed collateral practices across major asset classes, including bilateral OTC derivatives, centrally cleared derivatives, exchange-traded derivatives, repos and securities lending, and TBAs. We also walked through the operational workflows that support daily margining and collateral settlements. Finally, we discussed collateral optimization, focusing on how funding costs and eligibility drive collateral allocation decisions. Thank you for attending the lecture. If you have any questions or comments, please do not hesitate to reach out via the comments or email. I'm looking forward to seeing you in the next session.